From the morning reading, the Spider, another new all-time closing high. All 9 sectors moved higher on Friday. XLU, XLF, and XLK were the strongest sectors, while XLI was the weakest sector. All futures fell 28 cents to close at 44.26. On the S&P 500 snapshot, the third record close of the week, the S&P 500 hesitated at the open and remained in a quandary for the first 45 minutes or so, then rallied to a midday range, after which it drifted higher to its closing 0.46% gain within 8 ticks of its intraday high. It finished the week at a 0.61% gain and another record close, the third of the week, one on Monday, another on Wednesday, and again on Friday. The yield on the 10-year closed at 1.57%, unchanged from the previous session. ETF investors have been clamoring for index exposure. It was recently noted how money was flowing into major index ETFs, and that has translated into a rising number of shares outstanding. That kind of activity has preceded some prior market peaks, but the growth in shares hasn't been extreme enough relative to the price action to be worrying just yet. Traders' positioning is more worrisome, however. Large speculators in the major index futures were holding about $34 billion worth of contracts as of Tuesday, among their highest exposure in history. Unlike futures traders, margin stock investors aren't as enthusiastic. Margin debt declined again in June and remains more than 10% below its all-time high, even as stocks tickle new highs. That might seem like a good thing, but historically it's been better when debt has been rising versus falling. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:31 a.m. Mountain Time, and I am recording this in preparation for the market day of July the 25th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Let's go ahead and dive into the morning report. And at the time of this cut, all 4 of the broad market indices were wrapped around scratch. Not enough difference from scratch to make any comment at all. And crude oil, we're down almost 1%. Euro's up just above scratch. Bonds are down just below scratch, and gold is down about 0.5%. Overseas action, especially in Asia, is almost all wrapped around scratch as well. China up 0.1%. Hong Kong just above scratch as well. Japan just below scratch. Germany is up about almost 1%. United Kingdom down just below scratch. In terms of macroeconomic reports for today in the United States, there's nothing. In terms of looking forward, got a couple yellow reports. There's a consumer confidence and new home sales. Those are the 2 of note for the next day. In terms of current volatility conditions, as you would expect with all-time highs, volatility continues to remain exceptionally low. Short-term VIX almost getting ready to break into the 9 handle. It's at a 10.22. Skew remains just a teeny bit elevated at a 128. Anything over 125 gives us a warning level. In terms of IV percentile, they're all single digits. In fact, they're all less than 5. On the S&P, you have a 5, the Russell a 4, the NASDAQ a 1, the Dow a 2. So our implied volatilities are about as low as they've been in the last 52 weeks across all the indices. In terms of standard deviation moves on a close-to-close basis, the only one that put in something exceptional on Friday was the Russell. It was up by a standard deviation move. In terms of the charts, let's go ahead and go there. And this is the S&P. You see in the Globex overnight we had a new all-time high, but that has backed off and at this point is back inside the confluence and congestion range of last week. So nothing terribly bullish, nothing terribly bearish. In fact, the overall range last night is pretty mild. In terms of recent action, obviously, we had the huge move that broke through on our post-Brexit bull move, the all-time high in the area of resistance, and since then has started to apparently lose some momentum. You can see the angle here has started to slow down, and we started to trade inside each day from the prior day kind of thing. So we're looking to see, are we going to consolidate by time, or are we actually going to get a retracement? Either one could still happen. Nothing is really terribly apparent at this point. This is summer doldrums, really low trading volume. In fact, if we go to the Spider, the ETF, we can see volume, and volume all last week was really quite anemic down here. So it's not the easiest thing to determine as to which way we're going to move next in terms of a breakout above these horizontals, or if we're going to have a bit of a retracement. And that could certainly happen, as much as coming back to the prior area of resistance could become support, and that would still be extremely bullish, just a bull flag, and frankly it would give the market a time to exhale. Remember, the market has to go in and out, it has to breathe in, breathe out, or things can get imbalanced and quite violent as a result of that. And right now we're just waiting to see what kind of exhale. Right now it seems to be by time, and we may continue to move up at some point. What that trigger would be, it would not be macroeconomic reports, at least for today, so it doesn't seem to be an awful lot on the docket that's obvious that's going to spur this market one direction or the other. In terms of the Dow very similar to the S&P. They've been moving in a very high correlation of late. What has not been moving in quite the same correlation has been the Russell. Now the Russell did break through that diagonal and short-term horizontal resistance, but at the same time it has been in a sideways pattern for really 2 weeks, and has really as a growth oriented index isn't showing much at this time. In terms of the NASDAQ of course has been as powered by Microsoft and others, a little bit more bullish in the most recent trading sessions in a relative term, having broken through the prior diagonal and horizontal resistance, and is slowly climbing on up towards the former area of resistance, the all-time highs. So we'll see what happens when that index gets to that area. In terms of, let's take a look at crude oil. Crude oil is in danger of breaking down through the bottom of this potential wedge formation. So if that's true, then we'd have to think of this more as a channel and start redrawing this. But it's doing probably the most interesting chart of the day, and this isn't terribly helpful for showing that there's a lot of growth and health in the economy and the need for more energy when crude oil is falling like that. And then, of course, gold. Let's see what the risk-on, risk-off markets are doing. Right now, gold continues to be following through on the risk on, in that money's coming out of gold. And also in bonds, can't really say what we're doing here in the short term. In the sideways consolidation pattern, doesn't show anything obvious in terms of which way it wants to go. Obviously a retracement helping the risk on market as money came out of both bonds and gold, but bonds seem to be showing something of some short-term support and perhaps the inclination to push back up, but that has not yet broken out and shown that it's going to do that. Let's take a look at volatility. Volatility, of course, has been getting exceptionally low. We've managed to reload in the trading room in terms of being able to put on some long-term hedges to our core portfolio, some intermediate-term hedges using volatility contracts, and then also some short-term plays. So we've pretty much reloaded in the room in terms of being able to take advantage of these very, very low levels that we've had in recent sessions with the volatility area. So we're not yet in a VIX daily squeeze, though I would suspect that that could be coming if we continue with this much longer. And that would then set us up for the potential to have an expansion in volatility and be able to see something of a spike, perhaps. So that's kind of what you look for when you get a contraction and very low levels of volatility. You start stalking that expansion and make sure that you're prepared for that. Now, that doesn't mean it has to happen tomorrow. It can go with very low levels for a prolonged period of time, so always keep that in mind when you're doing volatility plays, especially when you're looking and stalking those expansions of volatility. If you look back at our pattern last summer, we spent basically 4 months with very, very low volatility before those August spikes in volatility and the equity significant drawdown that occurred last August. Okay, let's see if there's anything else we want to look at with the charts. I think that's probably it. We'll go ahead and go to the daily report. And the daily report is still holding up as pretty solidly bullish on all metrics. Market trend, intermediate term phase opinion still is phase 2. Trend reversal, the break of diagonal and horizontal resistance. We probably have started to mature in that. I'll have to take a closer look at that. The portfolio investor postures are 3 market timing signals. The first one from IBD, confirmed uptrend. The second one, GMI index, a perfect 6 out of 6, and even the GMI2 is an 8 out of 8. Buy signal has been in place since the beginning of July. On the third one, also mechanical, is our stock charts decision point scoreboard, and you see in the short term to intermediate term, all bullish signals all over the place without fail. There was some danger that the short-term signals could go to neutral, and that has not yet happened yet, so we have to say that, you know, it's still bullish in those 2 time frames. Now, that is against the one little stick in the wicket, as it were. The long term still has these mixed signals, and that's the one reason why we are still at the hedge risk level that we are. Position sizing opinions, both models are at 100%. Intermediate term market posture still very, very strong bull signals. You see they're all up over 95. Cannot hardly get higher than this. They are also reinforced by a bullish sentiment line. So certainly the bulls are totally in control at this point. In terms of the strength of the trend, you can see very, very high strength of trend. Anything over 80 is good. In terms of hedge warning status, we're still at a level 0 plus at normal with some cautionary aspects, and mostly that's related to this long-term mixed signals on the decision point market timing signal system. In terms of special opinions with on the various strategies that we follow in the trading room, option income strategies, VIX is in the acceptable window to initiate new positions for novice traders. It's in danger perhaps of falling below the acceptable window, so that will start to come into play if we continue to play in the area that we are. Cover call strategies, put selling, both are in very good condition. You know, you should certainly be adding additional bullish exposure as you gain confidence in this bullish move. Your ratios in the money, out of the money, are pretty aggressive right now with 1 in the money versus 2 out of the money at this point. It can get more aggressive. It can go with no in the money. You could go to, say, 1 at the money and then 2 out of the money. It can go to just out of the money strikes. So we're not as aggressive as we can be, but certainly more aggressive than we've been in quite some time in the setting up of these strategies. On the more aggressive ones, those charts, you might consider legging into the covered calls through out-of-the-money put selling, especially if we get a pullback. And indeed, that would be the place. I've got a number of things on my watch list that I'm looking for. If we do get a pullback, that I would look to sell some puts and put spreads, define risk positions, and of course a position size and a scale that I'm willing to own. But really, to put on new put positions right here at these all-time highs, and where everything seems to be really kind of extremely pushed without any kind of exhale or real pullback, is kind of tough. So I'm kind of waiting on that, being patient for a better opportunity to increase my exposure along these lines. In terms of covered calls, putting on one here and there, very, very kind of calculating as to adding exposure. I'm not going crazy in terms of just dumping a lot of new money into the market at these levels, but looking for specific opportunities. So kind of keep that in mind. In terms of those specific warning areas, it's still the same two low-grade volatility-based warnings. The volatility ratio warning is in the extreme zone, so it's in that reset position, waiting, firing, has not yet fired yet. Skew just above a 125, so in the first warning category. No warnings coming out of the trend base. In fact, the bulls can make a case. You know, they put in over 300 new highs on Friday. In terms of the key intermarket risk aversion indicators, they're all still strongly risk on. Nothing of concern showing there of yet. In terms of sentiment indicators, just a little bit excessive on stocks. So, we're going to start watching for potential reversal patterns. But, we just looked at the charts and we don't see any reversal patterns as of yet. Right now, all we see is consolidation. So, just kind of keep in mind that when you have extreme sentiment, it can go on much like, extreme volatility being really, really low. These conditions can persist for prolonged periods of time. So it's just mainly that you raise your radar sensitivity, that you're aware of the potential for something to develop, and you're watching for that. And that's where we are with sentiment right now in stocks. If you're in semis, the SMH, ETF, or cotton, those also have very high sentiment, so we'll also watch for potential reversal patterns there. In the fear and greed index, that particular sentiment also in the upper quartile, so extreme greed, just another way to say, we're looking for potential reversal patterns. Sector Pacific, pretty much a sea of green with the exception of energy, dropped into the short and intermediate term to neutral status. In terms of the percent change, you see Friday everything was green all the way across the board, and many of the sectors had a good week. But again, if we look at the ones that had the best week, that would be information technology. That was probably pushed by Microsoft, and healthcare. So it's not real obvious as a risk on versus a risk off story there. In terms of our stubs, we've been watching them carefully of late, and consumer staples was actually negative. Utilities put in one of the strongest performances of the week. It looks like it was the second strongest performance of the week. Bonds isn't listed here. But it's kind of a mixed bag, so it's not terribly obvious as to whether it was a lot about risk on or a lot about risk off when you look at the performance in terms of a percent change for the week. Of note is the 1 month, 3 month, year to date, and even the 12 months on a rolling basis is pretty much solidly green for most sectors now, with financials showing perhaps the most that they need to do in terms of catching up on that 1 year time frame. They're probably the primary outlier at this point, and indeed their performance in the last week was one of the probably the weaker performances. Certainly not as weak as some, but it has more work to do to be able to convince us that this is a strong, healthy bull. In terms of the relative rotation graph, you can see there's a lot of these that are starting to tail up into the upper right quarter, and specifically IYZ, which is telecom, FDM, internet. We've got positions in both of those in the trading room. And then home construction, also IYR. We have position in the IYR in the trading room as well. So that's always nice when you see that 3 of the top 4 are ETFs that you have positions in already. And then also note XSD, the semiconductor ETF, is also moving nicely towards this upper right quadrant. So if those are the kinds of places that are dominating your watch list, you're probably doing pretty well. Okay, well, we've gone to 20 minutes. Let's go ahead and wrap this up and get this into production. As always, we've got to do the disclaimers though, and if you need more time to review these disclaimers, hit the pause button. Also note the hyperlink down here at the bottom for the full set of disclosures. And we'll be back here tomorrow for the next Falcon Global Market Preview. In the meantime, manage that risk and everything else should fall into place. Go learn things.